that this past week was a really good example of that. I would highlight two specific things, and there's obviously many more that we could get into. One was related to, say, the Institute of Supply Management's Manufacturing Index. That came out. To us, that's a signal. It is really what is sometimes called soft data, in the sense that it's based on a survey and it's just saying, hey, are things getting better or worse? It doesn't try to quantify the amount that it's getting better or worse. But what we do know is that for the manufacturing sector, over the last 16 months, they've effectively been in a recession. And we finally saw some glimmers of manufacturing coming out of hibernation. Now, whenever you get that headline number, then we need to dig into the details as to who was surveyed, what are some of the details of that. And it is pointing to some very, very early signs of strength. So while it was exciting to see, hey, they're back to growth, it's not like it's rip-roaring growth. It might be the slow acceleration. The second one was we had so many Federal Reserve officials come out this past week speaking. I think every day it was like 4 or 5 of them. On one of the days, we had like 9 members of the Federal Reserve Board and the Federal Reserve presidents combined. There's 19 total. 9 of them were speaking, and it was a lot of dissonance. And they're all sharing their opinions, and we like to listen to what they're saying, because what we're trying to figure out is, how are they going to vote at the next meeting? So how are they looking at things currently, trying to anticipate what they might do when they meet next? And a lot of people have been thinking about, let's say, are they going to start cutting rates in June? One Federal Reserve official spoke, Neil Kashkari. He's from the Federal Reserve Bank of Minneapolis. And the equity markets on Thursday sold off pretty aggressively on his comments when he said, hey, we might not need to cut this year at all. Well, guess what? You probably really shouldn't listen to him, because he's not a voter this year. Just because there's 19 people speaking, only 12 of them get to vote. And he's not one of the voting members, but yet people, or the markets in general, heard what he said and the market sold off. So we're thinking that Chair Powell, he spoke, and he was really consistent with his messaging, saying it will likely be appropriate to cut this year. Really, the wild card to us is now, will it be in June or will it be in September? Will it be 3 times or will it be 2? And regardless of those 2 outcomes, we think they'll likely be cutting, and the economy is strong enough that it doesn't need the cuts quite yet.
It doesn't need the cuts because we're still see some of this positive momentum data and some persistence in inflation a little higher than expected. That would be on the one side. That's why maybe there's no hurry to cut rates.
Exactly.
And everybody's waiting for the other shoe to drop, which is some significant negative weakness, softness, the real recession to show up. And that's the balance. I sometimes think there are times when all of those Fed governors you're talking about seem to line up and be signaling the same direction. And right now, they seem to be crossing up those signals all over the place.
That's right.
And there's part of me that thinks that that's intentional.
It is. Yeah. It's anytime this happens, I'm reminded of the movie Ghostbusters, where they warn about not crossing the beams, right? And it seems like they're crossing the beams here as far as the signals that they're beginning to send. And that can create all sorts of market volatility and all sorts of problems. Hopefully they don't end up blowing up the Stay Puft Marshmallow Man or something like that, right? But there are these problems when they are out there talking, giving these cross signals. But I think that it's also healthy because there are these differences of opinion. Some of them do believe, just as you laid out, look, the economy is still, it looks like it has some decent momentum. Inflation, it's coming down, but maybe there's a bit of a setback. So why do we have to hurry? Then there's others who are worried that if we don't start cutting now, that problems are going to mount and then something might break. And I think that's really what they're worried about. And in fact, things have been breaking. Remember last year with Silicon Valley Bank, right? That kind of broke in terms, but the Federal Reserve was able to step in and use monetary policy duct tape to put things back together. And so I think that in terms of the argument for cutting rates sooner or more aggressively, to me, isn't really all that strong, as long as you trust that they would react quickly to things beginning to fall apart. And I do think that they will, because one of the things in the history of the Fed is that they have made lots of mistakes in the past, and they will make lots of mistakes in the future. But they do learn from the mistakes. And so then the problem, of course, is that the new mistakes are brand new, something that people haven't been expecting.
Try to make those mistakes be gentle and minor and easy enough to correct, and how quickly we forget about what looked like a mini banking crisis that seems so far in the rearview mirror at this point.
Dr. Brian Jacobsen is our chief economist at Annex Wealth Management. Mark Beck is our chief growth officer. Mark, what other chief economist is going to haul out? Remember 3 weeks ago, he hauled out an author from the 17th century, and today, Ghostbusters.
Yeah, he gets our genre of music of movies, doesn't he?
That's right. That is balance, ladies and gentlemen. That is fiduciary advice, comprehensive strategies, empowering education is how we roll at Annex Wealth Management. I think will be a great fit for you. The website, annexwealth.com. Click on that Get Started button. That's our week in review.